Welcome, everybody. My name is Regina Mangan of Liberty Blue Estate Agents. Thank you very much for signing up. We've had a fantastic number of people register for our star guest, Jim Power, who I will introduce in a couple of moments. I'd just like to start off with giving you a little overview and our opinion of where things are at based on factual data. So last year at Liberty Blue Estate Agents, we actually had our very best year in residential property sales to date. And what we're saying right now is that the market certainly has cooled since the last quarter of 2022. And that's what pretty much all estate agents are saying. Previous to that, for the last couple of years, the market was really hot. Now, when you take a look at the overall outlook for this year, what we're reading is full of doom and gloom. But what we're experiencing is a much more normalized market pre-COVID. And for the last 2 to 3 years, we've seen unprecedented markets. Like we had, first of all, during COVID, where the market was actually frozen because we weren't allowed out and people weren't able to view properties, followed by a massive pent-up demand and new needs for people as a result of lifestyle changes from COVID. I spoke with a mortgage broker this morning with ABC Mortgages, and it was really interesting what she had to tell me. She said, whilst the banks have increased to lending 4 times one salary based on central bank changes, the lender's criteria has actually tightened, and they're reviewing surplus income after mortgage payments. Now, if buyers don't have enough to satisfy the criteria, they won't basically get their mortgage approval. And most banks have a benchmark for what living expenses amount to. And the interesting thing for me was to hear that all lenders are viewing it very differently and have different criteria. That's why us as estate agents need to really push the message out into the marketplace for buyers to go to brokers, where the broker will know the criteria with different lenders and will also hold the buyer's hand and shop around for the best deal for the buyers. The 3 pillar banks at the moment obviously are lending: Avant, ICS and Finance Ireland. And as I understand, there are 2 new entrants coming into the marketplace, which means it will open up competition. And that's really, really positive for the housing market. Now, the demand for mortgages has started off really strong this year. According to ABC Mortgages, some house hunters are coming back for refresh mortgages, and second-time buyers, of course, can now avail of 90% mortgage lending. And she is saying a way busier period this January compared to January in 2022. The main bank lenders have actually slowed down their processing because they have a glut of applications. They cannot keep up with the amount of people applying for the mortgages. Their resources can't cope. So talking to you about what will that mean for the market, buyers now are getting their house in order. They realize they can't go on viewings until they're ready. Ultimately, a housing market is very much determined by the amount of lending activity that is happening. Okay, and the Banking and Payments Federation actually published their latest report today, which said that key mortgage drawdown figures for 2022 were 14.1 billion. Now, that's the highest level of mortgage lending since 2008. That's lending for 52,634 homes. Ultimately, mortgage lending drives the housing market. And what we've seen on the ground as well in terms of sellers, we've actually carried out 60% more of valuations in January 2023 compared to the number of valuations that we did for sellers last year. So the market is telling us something different, all of this data. My advice to anyone thinking of selling: get your house in order, make sure your title deeds and you have your title, your title deeds, and that your boundaries and everything is in order. Go to your solicitor early. have a really great team around you, because the sales that we saw fall through last year fell through because people weren't organised and in front of it. Anyway, without further ado, I would like to introduce you to Jim Parr, who is an economist for the last 35 years in the private sector. Jim runs his own economic consultancy for the last 12 years. He has a brilliant podcast, which I'd highly recommend you listen to. It's called The Other Hand, and he's from farming background in West Waterford. Without further ado, Jim, thank you very much.
Okay, thank you very much, Regina. Good afternoon, ladies and gentlemen. Delighted to be here again today to talk to you. Specifically, try and share here. Specifically, what I want to discuss today is, number one, the global economic situation, what's happening out there in the world. Secondly, what's happening on the interest rate side, because there has been a lot happening there, obviously, over the last 12 months. Update on what's happening in the Irish economy, and finally, wrap up looking at the Irish housing market. I'd be delighted to take any questions or comments at the end of the presentation. I hope to speak for roughly 30 minutes or thereabouts, and then we will open up to any questions you might have. Regina mentioned in her opening remarks there about the air of doom and gloom that has permeated stuff over the last few months. And what I want to really do is set the global economic context for the Irish economy in 2023. And coming into 2023, the key issues that were dominating sentiment, number one, as Regina said, a lot of fear about global recession. And the one interesting, and indeed over the turn of the year, most of the official and private sector forecasts on the global outlook were pretty downbeat. They were full of fear about 23, talking about recession, etc., etc. I am a bit more upbeat about that than that about the global economy. And for two reasons. One is that since November, energy prices, particularly natural gas prices, have fallen significantly. And in fact, natural gas prices are now back to where they were pre the Russian invasion of Ukraine. And secondly, the Chinese economy at the end of last year lifted its zero COVID policy, and that economy is opening up. And last year, Chinese economy grew by 3%, which is the lowest rate of growth in that economy in 50 years. This year, and that was largely due to COVID restrictions and the zero COVID policy. This year, as the Chinese economy opens up, and as the world's second largest economy, it will give stimulus to the global economy. And indeed, yesterday, the International Monetary Fund published its latest global economic forecast. It published three forecasts last year, and all three were characterized by a consistent downward revision to the growth outlook. Yesterday, for the first time in a while, it actually revised its growth outlook in an upward direction, largely for the reasons that I mentioned. But okay, I wouldn't get carried away about it. They're talking about global growth of 2.9% compared to a forecast of 2.7% back in October. But nevertheless, it does signify a move in a better direction. I'm not saying, and statistically, the euro area and indeed the United States actually avoided recession in the final quarter of last year. So there's no inevitability about recession in 2023. What I would say is that, it will be a challenging year for the global economy. There's lots of headwinds. There's lots of stuff to worry about. But the world is not going into meltdown as it did back in 2007, 2008. So that's important. The second issue revolves around interest rates and inflation. In the second half of 2021, as the global economy reopened, we saw this surge in repressed demand coming up against serious supply problems, and inflation started to take off. This time last year, the view from central bankers was that this inflation would prove transitory and that central banks wouldn't have to do much in terms of increasing interest rates to bring it back under control. The logic was that as 22 progressed, that bounce in repressed demand would start to level off and normalize, and supply, of course, would start to come back on stream. And as a consequence, headline inflation would gradually ease as 2022 progressed. And of course, on the 24th of February last year, that equation totally changed when Putin invaded Ukraine. And we've seen the Ukrainian war over the last 12 months have a huge impact on energy prices, on food prices, and also on building materials and industrial metals and so on. So inflation took off, and October it peaked, at levels we haven't seen in 40 years. So we're talking about very high levels of inflation. The good news, of course, is that since October, the headline inflation rate is starting to move back down again, largely because energy prices are in decline. From a central banker's perspective, as I said this time last year, central bankers didn't believe they would have to do very much on the interest rate front. That changed after the Russian invasion. And I'll talk more specifically in a second, but we've seen, since the middle of last year, a significant increase in interest rates everywhere. I'll be more specific about that in a second. The third issue of concern is what's happening on the political front. Globally, at a global geopolitical level since 2016, really, the Brexit, we've seen pretty bizarre global geopolitics. We had the Brexit vote, we had the emergence of Trump and his anti-globalization, anti-free trade agenda. We've seen the rise of authoritarian leadership around the world, with Xi Jinping in China increasingly concentrating power in himself. Excuse me. We've seen Erdogan in Turkey, Orban in Hungary. We've seen the UK political system basically implode with dire economic consequences last October. So global politics is pretty scary at the moment. There is no doubt about that. And of course, Putin's invasion of Ukraine, the biggest issue there. And in that regard, the Ukraine war, unfortunately, is ongoing. It's difficult to see how this war can end anytime soon. So I suspect we're just going to be subjected to this ongoing sort of stalemate between Ukraine and Russia for the foreseeable future. And of course, from an economic perspective, the concern is that although the food supply chain and the energy supply chain has eased somewhat in recent months, the fear would be that this war escalates and that it starts to seriously disrupt those prices again. So it's one, unfortunately, that will continue to linger in the background. China, the news there is positive because, as I say, the world's second largest economy last year experienced the lowest growth in 50 years. It is now reopening. You will see a strong rebound in Chinese growth. The downside to that, and there's a downside to every upside, unfortunately, the downside to that is that as Chinese growth comes back, the demand for energy, particularly and oil, will start to increase. So there's a danger that demand supply imbalance in energy markets will push prices higher. It's one to watch, but I think the positive economic impetus from China will offset the negative impact on inflation. Financial markets, equities, bonds, property were generally weak around the world in 2022 against a background of intense uncertainty related to Ukraine, inflation, rising interest rates, and so on. I think 23 looks like being a more stable year, but I think there will be volatility there depending on political news really from Ukraine. So in a nutshell, the risks to the global economic outlook are obvious. There is still intense uncertainty, and a lot of that uncertainty does revolve around the war in Ukraine. But I stress that over the last month, there has been a significant readjustment to the view on the global economy this year. Certainly, there is more optimism about at the moment than we've seen for some time, but I would not be naive about it. It's going to be a challenging year globally, and lots of risks and uncertainties. On the interest rate front, we've seen Central bankers reacting quite aggressively. US rates increased from 0 to 4.5% since March of last year. There's another rate increase due next week. The European Central Bank took rates from 0 at the end of July to 2.5% by the end of December. I think we're going to get another 0.5% from the European Central Bank next week. And I would see, the ECB rate cycle increasing by 1% in the first half of the year. I would hope that another 1% onto rates would be sufficient from the European Central Bank's perspective. But there is always the risk, that central bankers can err on the cautious side and increase rates too much. But my call is that ECB rates rise by 1% in the first half of this year. So that would see over a 12-month period rates go from 0 to 3.5%. And of course, that has fed directly into mortgage rates and particularly into tracker mortgage rates. So that's the global backdrop. The news on the Irish economy has been really unambiguously positive. And that kind of reflects what Regina was saying in introductory remarks about her business in the last 12 months and the volume of transactions in the housing market. Ireland actually performed incredibly well last year, despite the global problems. GDP, which does exaggerate the real health of the economy, it expanded by 12.2%. I would estimate that the real economy here expanded by between 4 and 5%, which would have been by far the strongest performer in the global economy. Tax revenues incredibly strong. We collected 83 billion last year, which is the highest on record. The labour market also very strong. Employment at the end of September at 2.54 million, which is the highest level of employment we've ever seen in this country, well above where we were prior to the crash in 2007. The unemployment rate in January at 4.4% of the labour force. That number was published this morning. That is virtually full employment. The export side of the economy is booming. The first 11 months up by almost 27%. The chemical and pharma sector, which accounts for 65% of those exports, which is a particularly important part of the economy in the Cork region, for example. But even there, in Dungarvan, it has a significant presence as well. So that side of the multinational sector is booming. But the biggest indigenous export sector, food, the value of food exports last year up by 22.2% to reach a new high of 16.7 billion. About 15% of that is due to higher food prices, but there was also an increase in the volume of food exports. And that's really important for the rural economy in the countryside. And despite Brexit, the Irish agri-food sector continues to perform strongly. On the other side of the equation, and no surprises about this. In fact, if it had been anything other than this, I would have been surprised. But consumer confidence took a hammering last year. We as consumers, we were exposed to rising interest rates, the Ukraine war, the cost of living crisis, all sorts of uncertainty about energy supply and energy prices, so on. So consumer confidence took a hit. And in fact, by December, it had fallen to levels last seen in March 20, which was the month that the COVID lockdown happened. And prior to that, it was the second half of 2008 when the global financial crisis was actually erupting. But in January, it jumped a bit. And in fact, consumer confidence is now at the highest level we've seen in about 7 months. So consumers are justifiably nervous, but they're not about to go into meltdown. And in fact, this was reflected in consumer spending last year. Despite the decline in confidence, in consumer confidence, the value of retail sales increased by 7.5%. Obviously, that growth was heavily driven by higher prices for everything we're buying. But if you adjust for inflation, the volume of retail sales last year fell by just 0.6%. So virtually flat. And given all of those global headwinds, the cost of living pressures, rising interest rates, etc., that was a pretty decent performance by the Irish consumer. At the end of October, we had 149.3 billion sitting on deposit in the banking system. During the 2 years of COVID, 2020 and 2021, we saved about 16 billion more than we would normally save, quite simply because a lot of people in the economy continued to earn but couldn't spend, so savings built up. In the last 12 months, those savings have continued to grow, but last year it was more to do with nervousness about the future. It was precautionary saving. But whatever the explanation, 149.3 billion at the end of October is the highest level of personal savings we've ever seen in this country. And it just shows that the personal sector here, and this is an aggregate figure because within that there will be segments of society struggling, other segments doing very well. But on aggregate, the personal balance sheet in this country is pretty healthy, and certainly a hell of a lot healthier than it was prior to the crash back in 2007, 2008. Housing, which I will be going on to discuss a little bit later on, in my view, is the biggest economic, social and political challenge facing Ireland. Now, I just want to run you through very quickly what's happening on the inflation, and some of these, just want to take you through some of the graphs demonstrating what I'm saying. Consumer price inflation peaked at 9.2% in October, fell to 8.2% in December, and yesterday the CSO gave a preliminary estimate that has fallen back to 7.7% in January. Still way higher than we've seen in recent years, but it is starting to moderate, and I think that will continue over the next 12 months. This is a breakdown of where the inflation has come from in the last 12 months. The year-on-year change is the right-hand column. And we see overall inflation December 8.2%. And within that, food is becoming a big issue. Food price inflation up 12%. That's the first time in 30 years we've seen inflation in the food sector, and that's reflecting Ukraine. But then you look at private rents up 10.6%, a problem. We look at mortgage rates up 22%. That's reflecting what's happening on the ECB interest rate side. You know, we've lived through these increases in mortgage rates with further to come. And the other point, I guess, is that we saw in December petrol, diesel, home heating oil prices, they fell sharply during the month. And that is expected to continue, which will lead to or contribute to a gradual easing of inflation back towards 4.5–5% later in 2023. Still too high, but moving in the right direction. This is the labour market performance, record levels of employment at the end of September. This is the unemployment rate, virtually a fully employed economy. And for many businesses, the recruitment, retention of workers is a big challenge. And of course, wages under pressure against that backdrop. This is the consumer confidence piece. You can see out there on the right-hand side what happened during 22, as I've explained. Bit of a bounce in January, reflecting just falling energy prices and just this better level of confidence about the world economy in 2023 that I've described. This is the household savings piece. You can see out there on the right-hand side, over the last 3 years, there's been a pretty strong step upward adjustment to household savings. And indeed, these savings are finding their way into the housing market in terms of providing deposits and so on. So that's clearly a driver and will be a driver of demand in the housing market into the future. This is what's happening on the tax revenue side. And to me, there is no better indicator of what's happening on the ground in an economy than what's happening on the tax front, because it is a real strong indicator of economic activity. And you can see there over the last few years, strong economic growth in this country has generated very strong growth in tax revenues. And in fact, that growth in tax revenues facilitated another positive for the Irish economy in 23, and that is the budget of 11.2 billion that was introduced on the 27th of September last, that budget was totally funded out of budget surplus rather than borrowed, as was the case in the UK last October. So that surplus has been driven by very buoyant tax revenues. So the story is, and I will bring all of this back to the housing market a little bit later on, but the story is, we can never be certain about the economic future. And anybody believes that an economist or anybody else can predict the future with certainty is naive, to put it mildly, because economics and economic outcomes are driven by political events, they're driven by human behavior and so on. So there is no certainty. But I've just tried to balance up here using a balance sheet format, the positives and the negatives that will impact on the Irish economy in 23 and indeed beyond. On a positive side, as I've described, the economic momentum of the economy was very strong in 2022, and Ireland certainly defied those external headwinds. Record levels of employment, low levels of unemployment, a stable banking system in the sense that, okay, we've seen the exit of banks like Ulster and KBC, which is a problem, but the remaining banking system is financially stable. In other words, it does not have the sort of dangerous exposures that it had back in 2007, 2008. The public finances are very buoyant. Tax revenue growth very, very strong. Record level of household deposits, and in a sense, comparing us to 2007, 2008, the personal balance sheet here is very strong. So lots of positives. But then on the other side of the equation, what are the threats? What are the negatives? What do we need to watch in terms of assessing the Irish economy over the coming year? Well, the external environment, I've explained, less negative than would have been the case a couple of months ago because of falling energy prices and the reopening of China. But, having said that, I think the external risks are very, very clear, particularly the Ukraine war. We're seeing interest rates continuing to rise. And as I say, I think you will see the European Central Bank deliver probably another 1% or perhaps a little bit more by the middle of the year. Cost of living pressures, despite the easing of headline inflation on the back of energy, cost of living is a problem at the moment. And one of the real issues is that over these couple of weeks, we're starting to see the arrival of the electricity and heating bills that relate to that very cold spell we had back in late November, early December. In fact, I got my own gas bill yesterday, and it did give me a bit of a fright. The cost of doing business, likewise, energy particularly, we've seen a significant increase in the cost of doing business. The housing market, to me, as I said, it is the biggest economic, social and political challenge we're facing. Geopolitical concerns, I've mentioned what's happening at a global level. And the final piece I want to talk a little bit about is what's happening on the global technology front. Last year, we collected around 23 billion in corporation tax, the highest ever by a mile. 10 years ago, we'd have been looking to take in 4 billion. 85% of that is paid by the multinational sector. And in turn, 10 companies pay 55% of that corporation tax. So we have a very, very heavy exposure to a small number of large multinational companies, some of whom are in the technology space. And at a global technology level, what we've seen happen over the last 3 or 4 months is that a lot of large tech multinationals like Google, Amazon, Stripe, Salesforce, a lot of these companies, Spotify, are announcing significant job layoffs. On average, roughly 10% of their labor force is being expanded. What's actually happening there is that during the 2 years of COVID, as the demand for online shopping and technology solutions to remote working increased dramatically. Tech companies got very optimistic about the future. They hired aggressively, paid very high salaries, and suddenly COVID ends. We see the global economy in 2022 starting to become a lot less certain. Many of these technology companies quite simply now realize we have way too many staff. So we're seeing these significant job layoffs. And indeed, there's about 126,000 people employed in the tech sector in Ireland. If we were to lose 10% of that, you're talking about 12, 13,000 people. But what I'm picking up from recruitment agencies at the moment is that a lot of non-technology companies who could not compete with the tech companies for staff over the last couple of years are now starting to hire those technology workers that have been displaced. I know one insurance company that recently hired 3 technology people who had lost their jobs with a multinational. And I think, you know, technology expertise is required in virtually every area of the economy. So I think a lot of these workers will be picked up again, albeit perhaps at lower salaries than they've been enjoying with their tech employers. But at least in terms of employment, I don't see a significant adjustment. Where I would be a little bit worried is that the 23 billion in corporation tax, you know, some of that comes from those global tech companies. They're cutting jobs because their profits are under pressure. If their profits are under pressure, they're going to pay less tax. If they pay less tax, it is going to impact on the corporate tax take here. So that is something that the Department of Finance is quite exercised about at the moment, is monitoring very, very closely. And I would see these global tech pressures as less of a concern for employment as for the corporation tax take. So it's one to watch. It's a risk factor. But in overall terms, you know, I am pretty upbeat about the Irish economy in 2023. This is what's happening on the house price front. These are the year-on-year growth rates in house prices. The red line is outside of Dublin. The blue line is the national average, and the green line is Dublin, excuse me. And since the first quarter of last year, we've seen a significant decline in the headline rate of increase in house prices. They're still increasing at a positive rate, but the rate of increase is decelerating. There's 2 key reasons for that. One is affordability. Prices had quite simply got too high. And secondly, in a rising interest rate environment, that is, there's no surer thing than rising interest rates will impact on the housing market, and that is happening. I would actually welcome that, because the last thing in the world we want is just this incessant upward pressure on house prices, creating another bubble, resulting in the sorts of problems we've had in the past. But anyway, that's the point. House price inflation moderating. This is a bigger issue than house prices, although related. What's happening on the rent side, private rents, they fell a little bit during the early months of COVID, but they've taken off since then. So rental pressures are dramatic out there. This is what's happening on the house completion side. You know, people wonder why we have a housing problem. And the housing problem is quite simply an imbalance between demand and supply. Strong demand. The census showed that our population hit 5.1 million in April of last year, which is the highest population we've had since the famine. So growing population, pretty strong economy with strong employment growth. And basically between 2011 and 2017, we stopped building houses. It's gradually picked up since then. And last year we delivered 29,852 new housing units. That's good, but to put it in context, we need to be building, depending on who you listen to, somewhere between 40 and 65,000 new housing units per annum to satisfy the ongoing demand, and secondly, to satisfy the pent-up demand that's in the system. So it's moving in the right direction, but there is a long way to go. We hear a lot of talk about Ireland having a unique housing problem. But the international evidence doesn't back that up. This is a graph showing real house prices. The blue line is Ireland, the orange one is the euro area, the grey one is the OECD average. And you can see there on the right-hand side, in 2021, which these data refer to, we're pretty close to the international average. The one thing that does stand out there is what happened between 2000 and 2008. You can see the blue line getting totally out of control at that juncture. So the point is that the Irish housing market is nowhere like as exposed as it was back in 2007, 2008. This is the house price to household disposable income. You can see there we're very close to international norms as well. In fact, we're lower than the Eurozone average. But you can also see there that in the period 2000 to 2007 approximately, Ireland was way out of kilter with international norms. And this is the global house price to rent ratio. And you can see what happened 2000, 2007. You know, the thing that stands out is just how bizarre that period was, whereas now we're much closer to international norms. You know, that should give us some sense of comfort. So finally, just to wrap up, the demand, as I've described, is still fundamentally strong. It's being driven by demographics, growing population, a young population moving into the household formation age group. Employment is strong. The general economy is doing well. Supply is improving, but as I say, there's a long way to go. Rising mortgage rates are affecting affordability, and that is being reflected in the moderation in house price inflation. I think logic would suggest that over the remainder of this year, that deceleration in house price inflation will continue. And I am noticing that the asking prices, particularly all over the country, as far as I can gauge, are starting to come down. I would see that as a positive. I don't see the markets experiencing a significant downward price correction. I don't believe we're going to see a 2007, 2008 type shock. One can never rule out that because of some sort of global shock, but things look reasonably stable at the moment. And as I say, housing is the most significant economic, social, and political issue facing Ireland at the moment. And I'll just leave you then with twice a week, Chris Johns, a friend of mine, and myself record a podcast called The Other Hand. We also write a lot of stuff about the Irish economy. So if you're interested in the sort of discussion it's not really a discussion yet, but the sort of commentary I am giving you today, Chris and myself discuss this sort of stuff on an ongoing basis twice a week. So if you like it, sign up and tell your friends about it. So I'll hand back to Regina at this stage. I can't see her, but I'm sure she's giving me dirty looks to shut up. I'd be delighted to take any questions at this stage.
Jim, thank you very much for an absolutely brilliant presentation, and you're bang on time, so don't worry. We've a good number of questions, no surprises. So I'm going to go straight into it. Lisa has asked, hi Jim, what is your economic views of the level of regulation that currently is on the rental market in Ireland, i.e. the RTB?
Okay, Lisa, I did a report for IPAV and the Irish Property Owners Association last June, where I looked at the private rental market and I examined the statistics, and I showed that there has been a significant decline in the number of private landlords. There's been a significant exodus over the last few years. The reasons are, number one, the tax treatment. They're paying tax at 52%. Number two, they are subject to intense regulation through the Residential Tenancies Board. And basically, a lot of landlords, and of course, many, depending on where you're operating, are subject to rental pressure zones, which aren't working anyway. So basically, a lot of private landlords have just decided, I'm out of here. It's not worth it. I'm not making enough money. There's way too much hassle. There's way too much regulation. And I thought actually that the government was going to do something about it in terms of reducing the tax burden on private landlords in the budget on September 27th. In the event, they did very little. And I think the reason for that was because the Robert Troy controversy and his rental property had erupted just before the budget. And I think the government was afraid to do anything that would be deemed to help landlords, given that sort of scandal that had erupted. So, the bottom line is private landlords are needed in the market. They are exiting the market because of taxation, because of regulation. And unless government does something about it, that will continue. There is no doubt about that. And people say, well, if a private landlord sells up, the house doesn't disappear. Somebody buys it and it's satisfied demand. That's fine in the aggregate. But the market is made up of the rental market and the buy market, okay? The owner-occupier market. And what you're doing is you are increasing the owner-occupier part of the market, but you're reducing the rental part of the market. So you're creating a problem in the private rental sector. And,
Jim, can I jump in there? Because I have a good few questions, but I would like to ask, I would just like to add to that topic. We have seen a huge number of landlords exit the market because we manage over 350 properties and have done so for 26 years. But not all things are equal in my view. So I'd be interested in your thoughts. Like, for example, we'd landlords who bought at the peak of the market, 2006, who paid close to 400,000 for a 2-bed apartment in Waterford. It had a tax break attached to it. Then when the crash happened, they dropped to 30,000, and those same properties where they paid close on 400 today are worth, look, they're thereabouts 120,000. Now, the new investors, you can understand why they're leaving, right? They're leveraged up to the hilt. A lot of them are on interest-only mortgages. The rents were below the mortgage repayment, high taxes, and all the things you just discussed. You have new investors then who can buy from their pension pots. That's where we're seeing the market now. A lot of people buying from their pensions. And I think there's a huge opportunity in Waterford. So if somebody's buying a 2-bed apartment for 120, 130, they're getting a gross yield between 8 and 10%. They understand the regulation, but they're not leveraged. They're cash buyers, more or less, the majority of them. That doesn't mean it's a level playing field. It's a great opportunity. Would you agree?
Yeah. I mean, absolutely. A lot of the landlords that are getting out, as you say, have, have been landlords for a long time and have experienced a sharp negative equity situation in their property. So they're getting out now. But yeah, definitely there's an opportunity. But the statistics don't show at the moment that there's a lot of people getting in. There's definitely a net exodus from the rental market still.
And I suppose lack of consumer confidence drives things. Would that be fair to say?
Yeah, it would indeed. Absolutely.
So a good few more questions. Look, Lisa's asked, do you see house prices coming down? But you've already said you don't see a downward house price correction.
I think, Lisa, that the rate of inflation is definitely decelerating, and house prices are leveling off. You may see a modest downward adjustment. And very modest, I would say. So really, I'd be looking at a pretty stable housing market in terms of prices over the next couple of years. I could be proven wrong within a week on this, but I think that would be very desirable, because the rate of price increase that we've seen over the last couple of years is not good for the economy. It is just forcing people to borrow more money, and is creating vulnerabilities.
Jim, thank you very much. Now I have another question here from an attendee. Jim, you mentioned that of the 23 billion corporation tax, that 85% from multinationals and that 55% is from 10 companies. Can you clarify if the 55% is 55% of the 85% or 55% of the 23 billion?
Okay, I'm not surprised I created confusion. Okay, we collected around 23 billion. 85% of that is paid by the multinational sector, and 55% of the total corporation tax take, 55% of the 23 billion that comes from 10 companies.
Wow.
So
Okay.
that's what we call concentration risk. If some of those companies got into difficulty, we have a problem. And in early January, when the Department of Finance published the Exchequer returns showing these buoyant tax revenues, they stepped in immediately and said that up to 10 billion of that corporation tax take could be vulnerable at some stage. So government don't go out and spend that money on the basis that it's going to be around forever. And that is the Department of Finance being cautious, but I think, and conservative, but I think appropriately so.
Thank you very much, Jim. A few more questions. Can the exodus of small landlords be slowed or stopped? What legislation or specific incentives would you see, Jim, as necessary to achieve these outcomes? And should small landlords be treated on their taxable income the same way as larger players, REITs, etc.?
Yeah, I mean, I don't see why not, to be honest. If I'm a private landlord and I'm being taxed at 52%, you know, compared to the institutional investors and the REITs that come in, get a much favorable tax treatment, I think the playing field does need to be leveled. You know, if the point is REITs and those investors fulfill a specific part of the market. But if I sell a rental property in Dungarvan, for example, or in Carrick-on-Suir, wherever, it is not unlikely, it is not possible that a REIT or an investment fund will come in and buy that property. So we need private landlords operating alongside the institutional landlords. That's what makes a functioning market. And the playing field needs to be leveled, from a taxation perspective. But government is could be accused of total cowardice because they would not like to do anything that would be deemed to be helping the evil landlords out there. There's a narrative out there around landlords that I find quite disturbing, and I'm not a landlord, okay? So I don't have a vested interest here. But there is a narrative out there that is very, very negative. Landlords fulfill a very important function in the market, and they need to be given whatever incentives are required to keep them in the market.
Of course, and we have a transient society and not everybody is prepared or in a position to commit to purchasing a property. And the government is outsourcing employees from outside of the country. Do they expect them to land off the plane and go straight and buy a property? That is just unreasonable. And let's not forget that the way tenants are treated by the majority of small private landlords is definitely more humanitarian than these big REITs, who obviously make majority of their decision based on spreadsheet data as opposed to human needs. That's very, very important. Jim, good few more questions. In terms of building materials coming down, we've somebody here, I'm waiting to expand my business, which involves a new building. And how can there not be a recession when everything has doubled in price, from building materials to food to toilet paper and power?
Okay, I was at a presentation last week from AECOM, their quantity surveyors, and amongst other things, but they were saying that tender price inflation last year was running at 15% plus. They expected to moderate this year and tender price to increase by about 5%. What happened last year, and this was due to the serious disruption during COVID, but also the Ukraine war, building materials and came under serious pressure. And overall, construction costs last year, on average, increased by 17.5%. Sand and gravel up by 11.3%, cement 19.1%. That's the average. And in fact, in December, cement prices were 29.2% higher than a year ago. Steel up 38.9%, rough timber 14.8%, machine timber 32.4%. And of course, so all of these costs have increased dramatically. And on top of that, then there are labor scarcity, skills shortages, and wages are rising significantly. So the cost of delivery in the construction industry is under significant pressure at the moment. And that is why many developers that I know have basically shut up sites, because they just cannot justify the costs at the moment, given what they'd be able to sell the properties at. So they are actually voting with their feet at the moment. The hope is that during 2023, and a lot of this is contingent on Ukraine, obviously, but the hope is that we won't see the same sort of material inflation feeding through the system, and that things might get a bit more viable. But it's a huge problem. So I think actually what needs to happen is that government needs to step in and help alleviate these pressures for developers and small builders, big ones, because we do need developers to deliver housing to solve the problem.
Great, thanks very much, Jim. I'm looking to retire to Waterford this year. I have a property to sell in the UK. I'm wondering if the housing market in the Republic of Ireland is on a similar road to that of the UK. I think you've answered it, but I'll leave you answer again.
Yeah, it's not, to be honest. The UK economic and political system at the moment is a mess, and the IMF's forecast yesterday showed that the UK is forecast to be the only G7 economy that will contract on average during 2023. And in fact, and this is not a statistic the UK should be proud of, the Russian economy is forecast to increase by 0.3% this year. The UK economy is expected to contract by 0.6%. So Russia outperforming the UK economy. UK, it all goes back to the dreadful mistake that was made back in June 2016, when the United Kingdom voted to leave the European Union. So and the house prices are now falling in the UK, and they'll fall, I think, significantly further. I think that is totally at variance with what's happening in Ireland.
Great. Thank you very much, Jim. Money and value in constant conflict, interest rates, particularly in Ireland. Is there a future alternative euro where we can access better value for our pounds in other banks other than Irish banks? Is this first space of investment security dysphoria?
I've no idea what that means.
So money and value in constant conflict. Is there a further alternative euro where we can access better value for our pounds in other banks? In other words, do you recommend other countries to invest our euro in, is how I'm interpreting it?
Well, I mean, I may be totally misinterpreting this question, but number one, the euro is here to stay, okay? Number two, it ain't going anywhere. Number two, I mentioned in a slide that the banking system here is stable, and it is stable. It does not have the financial exposure that it had back in 2007, 2008, but it is way too small. We're back to 2.5 banks, virtually fewer smaller players in the mortgage market that Regina mentioned. But the problem now is that international banks are not interested in Ireland at the moment. It's too small. The track record back in 2007, 2008 isn't exactly great. So I don't see the opportunity for Irish customers smaller customers to diversify into European banks at this juncture. Just not interested in the Irish market. Okay,
thank you, Jim. I think you've answered that. Couple of other
I see questions. David Renz is expecting Clare to reach an All-Ireland this year.
See the Ireland. Right. Can I ask, Lisa's asked a few more questions. On a local level, can you comment on the local economy performance and outlooks outside of Dublin, for example, Waterford, Limerick, Cork?
Yeah, I mean, this is also, not something that is readily admitted to, but the regions here have actually performed pretty well over the last couple of years, and the regional imbalances have definitely narrowed somewhat. I mean, Dublin is still the driver of the economy, but the regional economies like Galway, Limerick, Cork have performed very strongly, and the multinational presence in those regions is really important. And for Cork, the buoyant chemical and pharmaceutical sector, which is well entrenched in the Irish economy, is really good news. So I would expect those regions to continue to perform strongly. And there's a lot of investment going in there. For Waterford and the Southeast, we don't have the same level of multinational investment, but there is still a multinational presence that's important. Tourism in the Southeast has increased dramatically. And of course, the Waterford Greenway has made a major contribution to villages like Kilmacthomas, and indeed it's given a major boost to Dungarvan. So there's a lot of positive news actually coming out of Waterford and the Southeast in recent times. And I think that is actually reflected in the property market performance in a town like Dungarvan, where the demand is definitely outpacing supply at the moment. So I'm pretty upbeat, I have to say, about the regions. And excuse me, I think COVID actually did hammer home the whole quality of life issue and the quality of life you can get from living in a regional area as distinct from Dublin or a major city. So I have to say I'd be pretty upbeat. I think there's a lot of good stuff happening, but I am an eternal optimist, okay?
Great. And look, let's not forget that Ireland was voted best place to live in, or sorry, Waterford was voted best place to live in Ireland. And that is because of the quality of life. And we saw that reflected in the prices for sure. Jim, do you expect the larger institutional investors, example pension funds that invested for rental income at lower interest rates, to stay in the market with current higher interest rates?
I think I think there will be a slowdown in the inflow, but I don't see a mass exodus. I think a lot of those institutional landlords are here for the long haul. So I don't see them. They're still getting reasonable returns. It's a good, stable environment in which to operate. So I don't see a mass exodus, to be honest.
I agree. They're taking a long-term view.
Yeah.
Jim, if Sinn Féin come into power, what impact will this have on the rental market for landlords in the market, in your opinion?
Okay, I mean, I mentioned geopolitical risk, and from an Irish perspective, I would say that whether you would regard this as a risk or not is one's own choice, okay? But there's a strong chance that Sinn Féin may form part of a government late 24 into 25, okay, based on the opinion polls. Sinn Féin will not be in government on its own. If it is in government, it will be with other party or parties, okay? But Sinn Féin's economic policy platform, as we understand it, and this will be elaborated on over the coming year, I assume, but based on Sinn Féin's input to the Commission on Taxation and Social Welfare last year, for example, and based on what we hear, Sinn Féin is a high spend party. You know, they believe there is a money tree out there and they will throw money at all problems. So if you adopt a high spending approach, you have got to adopt a high taxation approach to pay for that. So I suspect there will be some type of wealth tax. There will be some type of tax increases for people who are deemed to be high earners. And the definition of a high earner is not clear. Is it 60,000? Is it 100,000? It depends on which Sinn Féin spokesperson you listen to on any given day. The bizarre thing about Sinn Féin and some of the left parties, and I would regard Sinn Féin as very right-wing and very left-wing. It's almost come around to meet itself in the middle. But in some ways, what amazed me about the left is they are opposed to property tax, but yet want wealth tax. There's a huge inconsistency there, but that's what we are. I think small landlords under Sinn Féin will be okay, because I think Sinn Féin will recognise the importance of small private landlords in their in the Irish economy.
So Jim, bang on time, 1:30. I think it was an excellent presentation, lots of engagement from our audience, which we appreciate, and thank you everyone for signing up. It's great to hear you upbeat, and I think that's based on strong data and evidence, and Let's wish everybody well and hope you all stay safe, and health is actually our true wealth. Curve Mila Mahagut, thank you, Jim, and Slán go fóill.
Thank you very much, Regina. All the best, everybody.